All right, guys. So let's get into it. So we're now in Unit 5. Okay, we're now in Unit 5. And Unit 5 is reporting, credit, and sundry. Okay. Unit 5 is recording credit and sundry transactions. Okay, remember Unit 4 was just cash transactions. Okay. Right. So let's move on. So again, we're just as a recap, really. All right, we played around with the cash journals. Okay, but now in Unit 5, we want to talk about the credit journals and also the general journal. Okay, we've spoken about the general ledger, that doesn't change, and we've spoken about the trial balance. Okay, one or two other things we want to introduce there. All right, we've already spoken to this. We know what the journals are. It's just where we pull similar transactions together. All right, before posting them to the general ledger. All right. We also looked already on page in my textbook 103. Okay. There we looked at all the journals. Okay. We looked at all the journals on 103. Okay. Now we want to be dealing with the journals 4 going to 8. Okay. And I'm just going to quickly mention them now. The creditor's journal, that's where we're buying on credit. Okay? The creditor's allowance journal, that's where we are returning something that we initially bought on credit, or we are asking for a rebate. The debtor's journal, somebody is buying from us. Somebody, when I say somebody, I'm talking about either an individual or an entity. Okay? And then obviously the debtor's allowance journal, there we have our customer or client returning goods to us or requesting a rebate, okay? And then finally the general journal, we know that we enter transactions in there that are not being entered in any other journal that we've just spoken about, okay? Then definition of a credit transaction. Credit transaction really is just a transaction that is not concluded at the point of sale. So in other words, somebody, or should I say the customer, still owes the supplier of these goods or services, okay? Debtor transactions, all right, increase the balance of money owed to the business. Remember, debtor is somebody who owes us, the business, money. Creditor transaction, increase of the balance of money that the business owes, okay? Our liabilities are increasing there, okay? Then extending credit. Why would a business want to extend credit? Okay, that's what this slide is dealing with. Building closer relationships with clients, all right? Ensure they have an edge against the competitors, because if you're not offering credit, but I am, all right? Should a customer want to buy, all right, but doesn't have the full amount to pay for the product and service we're both offering, they're obviously going to come to me, because I can say, okay, just give me 20% upfront, and then the rest we can figure out by means of installment, okay? Then offer credit like that of your competitor. He sees that I'm obviously offering credit, so he doesn't want all the business to come to me. So what does he do? He begins to also offer credit terms to customers in that same market, all right? And then we want to sell directly to the customer, all right? So sometimes you might find that we're a wholesaler, all right? And then obviously you have retailers, right? Now we're talking supply chain type of things, okay? Now, instead of us going through a Clicks or a a Pick and Pay to sell whatever product we are actually selling, we can say, look, let's make our terms more favorable to the average individual or the average customer, so that as opposed to going and buying these things from these retailers, they can come directly to us, okay? So that would be another reason why we might offer credit. Okay. Now we have certain advantages to offering credit. Yes, before I continue.
This is kind of on credit, but I don't know if it has to do with businesses. So an individual has to have a specific credit score. Why is that?
Why is that? A great question. Hey guys, what's the answer? Why must an individual have a certain credit score?
So that the bank can be confident loaning them.
Okay. Is that what you wanted to say? You were like the first person who read that. Okay. What did you want to say? Same thing. What did you want to say? You were saying something. Okay. What did you want to say?
So I have a follow-up question to that.
Okay.
Then, okay, so we're supposed to have a specific credit score.
Uh-huh.
But for example, as students,
Yes.
we want to apply for credit.
Why?
Okay.
Why
Not necessarily as students. So as you grow up, you have to gain credit, if that makes sense. But
Well, you might need credit.
yes. So why is it hard? Okay, so you have to have credit.
In order to get a credit score.
Yes.
That's what I'm saying. Yes.
But why is it kind of hard to get credit? Because it's supposed to have a specific credit score.
Can I tell you something, man? If you're any man in this country, it's not hard to get credit.
Okay.
What they need from you is just evidence that you are actually earning something. In fact, I'll be very honest with you. Have any of you ever opened a clothing store? Okay. And you're not working, right?
I did work. My credit score was 656.
Okay, I wasn't going to answer. All right, but when you opened your clothing store account, and I don't know if there was anyone that I missed who said they have also. Did they require you to actually have a job?
Yes.
All right, they didn't just say, do you have a form of income? Okay, because I'll be honest with you, you could actually open up a clothing account based on your profit. They just need to know that you have a consistent income. That's it. So if you literally could show them that I have 500 rand that comes in every month from wherever, cool, they would actually say, okay, fine. Based on how much you actually get a month, we'll give you a credit of. So as long as you can provide proof that you actually have some form of income that consistently comes in, they will actually give you credit, at least for the clothing store. Now, I mean, if you're now saying I want to go buy a house with 500 rand, then we'll hit you now. Please stop wasting our time.
Isn't it basically with what my understanding is, is when credit was introduced
Yes.
as a buying like sort. Lots of people bought on credit, but they couldn't pay back because they didn't know how credit worked. So basically now, what banks do when you, let's say, buy a house, they're much more strict because people bought cars and houses on credit, but they didn't know what it was. Yeah. So exactly what I'm trying to say is that you buy on credit, but people in South Africa, it's much harder to get credit because of that.
In my experience, I don't know. I think actually in South Africa it's too easy because I think that's why people are over indebted. If you really look at it, you find that there's, if you look at, like, just Google it, search it, you find that a lot of people are over indebted and actually owe more in installments than their actual income that they generate.
Let's say if you look at it like, how can I put it? If you go and you want to buy a house on credit,
Yes,
right?
yes.
It's much harder than it always was because they have to look at every single aspect, and a lot of people get declined.
Yeah, I think now they're starting to say, you know what, there's no point in us just dishing out this credit because the truth is if we just give Aubrey this credit, even though he can't afford it, we're going to be the ones who are going to end up getting, it's gonna end up hitting us because at some point I'm gonna fail to pay, and then obviously they're gonna lose out on the installments that they obviously wanted to benefit from. So then they're gonna be stuck with trying to sell a house in order to recoup whatever they have lost. Does it make sense?
Yeah.
So it's not in their best interest to just give credit out, right? So that's what I think is happening now. But in the past, all right, and when I say past, for me at least, I'm sharing my experience. Recent past, it's been pretty careless. It's been, in my opinion, it's been pretty careless the way people have been able to access credit. All right. That said, just to go back to your initial question, credit score is literally just a gauge that we use in order to judge how good are you at paying your commitments. Okay. The purpose of that is, as you guys have highlighted, so that when I walk into a bank, when I go to a whatever store to get access to credit, they then can see how much they should give me, and also whether it's actually worthwhile for them to give it to me. Because obviously, when I take out something on credit, there's the assumption that I'll pay back. But whether I actually will or not is yet to be seen. Okay. Yes.
So if you don't pay credit back,
Mm-hmm.
do you get penalties or something?
Your credit score will go down. So and the thing about it is, as was highlighted, the lower your credit score, the more risky you are. So if you're more risky to borrow money to or give credit to, your interest rate will go up. So it hurts you in the long run. So unless you plan on never borrowing money in your life, or finding something on credit, then I'd advise that you try and ensure that you have the best credit. Sorry?
Isn't that a better way to increase your credit score?
By doing what?
By like borrowing money and paying it back on time to show that you are reliable.
Yeah, that's, yes.
If I put it like that.
But you know what? Be very careful, because you can very well begin to build a habit of buying things you can't afford. Because you get used to saying, I want an Apple laptop, or I want this, I want that. And because you have gotten used to the thing of, I can just get it on credit. Even when you don't really need that thing, you end up going and getting it on credit. So be very careful is what I would say. You are right, but I said be very careful, because habits, if you build the wrong habit, you might dig yourself in a hole as well.
So if you buy your house on credit basically and you don't pay your house at all, you get blacklisted, right?
Yeah, with any credit actually,
But
not just your
how
house.
does that work? If you get blacklisted, you can't buy anything on credit anymore.
So also it's about, okay, you obviously then speak to those who you're owing, and then you come to some sort of an agreement. Either you allow them to take the asset, or you agree on that I'm going to start paying my commitments. When you start paying your commitments, then obviously they will at some point take you off the blacklisting, and then you will have access to credit. But while you're blacklisted, of course, yes, you don't need it. All right, guys, I'm taking this last hand, and then we're going to move forward. Yes, you do. But I mean, if you're not paying, if you haven't been paying for, I don't know what exactly it is, for instance, maybe 6 months, then, and obviously they will call you after like the first month, after the second month, and they'll be like, okay, we understand maybe you can't afford to pay the 6,000, at least give us X. Okay? If you're not even meeting that, at some point they're going to blacklist you. All right? Cool. So great question. I love the engagement. But let's proceed. All right. So advantages of extending credit. Customer cash flow. Like I said earlier, the customer might not be able to pay for the good or service at the total selling price. So, or even if they can, they might be committing too much cash, which will not allow them to get through the month. So instead, they can just pay a portion, and then they obviously still have the cash flow that they need to get through the month. Then customer relations. Obviously, if I enjoy your products and services, and I'm not able to completely afford them, but I can take out the stuff on credit, then obviously I'm going to have a good relationship with you because I can still benefit from your services. And then with credit terms, it is possible to approach stronger customers. Okay? So somebody who doesn't necessarily, even though they can afford your product, but they weren't necessarily keen on buying it, all right, you can always push them to say, look, man, you don't even need to pay the full price. You can just pay X. And it's like, oh, okay, well, I already have a cell phone, but this seems like a decent device. Why not? Make sense? And I can afford those monthly installments. Why not? All right, pay the change to me, no problem. Okay. Then next one, logistics will be smoother as goods can be shipped when ready and not after clearance by the bank. Okay. And then more sales revenue. Obviously, we make more sales because of the credit. Okay, so certain goods would not have been sold because only if we're operating in cash only those who can afford would be buying from us. But now since we've opened up to offer on credit, then we have more people actually buying. Therefore, they're just paying by installment. So obviously our sales revenue is increasing. Does that make sense? And then finally, repeat business. Okay, repeat business. Okay, I think that one's fairly self-explanatory. Now there's the downside for the business. Remember, we're always talking about we're interested in the business. All right, we're talking from the business perspective. So cash flow. All right, I've sold the product, but I haven't necessarily made any money from it. Okay, and if my people are not, if the people I've sold to, my debtors are not paying me on time, I'm going to be in a situation where I'm now kind of stuck because I still have salaries, I still have wages, I still need to go and buy more product for my business. If everything was sold on credit and people are not paying me back, my shelves don't have any inventory on them. Can you see how that can present a cash flow problem? Some businesses shut down, not because they're not profitable, because they don't have cash. And this is why, I'm sure all of you have heard before, at some point in life, that cash is king. Because of this, okay? Risk of non-payment, okay, I think I've spoken to that. You might be credit worthy, you might have a great score, there's no guarantee that you are actually going to pay. Who knows, you might even just be preparing to skip the country, okay? So that's always a real risk, okay? You might go bankrupt. So at that point in time that you took this stuff from me, everything looked dandy. But then at some point you go bankrupt, then you obviously still can't afford, then you obviously can't afford to pay that which is due. Then leverage. If I buy from him on credit, I still need to obviously settle my bill. At any point in time, if I say I'm unhappy with the service or I'm not happy about one or two things, and I kind of am at an advantage as a customer because I can just say, look, if you're not willing to accommodate me, I'm not going to pay you. Now that puts him in a tight spot because he's like, yo, I need this guy to pay. So can you see how I have leverage over the person who has provided me with credit, okay? And then currency risk. So let's say you are exporting these ornaments, those nice crafts that people do. So somebody buys some of these crafts from you. Now your business is obviously exporting this stuff. Now you might find that the dollar might pick up against the rand. All right. So when they finally pay you, okay, in rands, right, your rands are not as strong as they used to be. So now when you now need to buy your inventory, let's say you're importing some stuff from America or wherever else, then you see that there's that currency risk. Because this person is paying over time, the value of the money that they actually give you might be worth less at the end of the day. Okay, so that's what currency risk is all about. Then organizational change is needed with credit control in place. You guys spoke about it. We spoke about it at great length. Credit scores. Somebody in the business needs to monitor, all right, or put in place a credit policy, all right? Who's then going to assess? Is Aubrey, does he have the right credit score? Score for this business? Can he actually afford to take, how much money can we actually offer him on credit with his account? People need to monitor that. You also need people on the phones to say, if he doesn't meet his installment, we need to call him. We need to send him an email. We need to, in the past, send post. Okay? All of those things, people need to do that. Somebody needs to do that. And that's going to cause a change in your organizational structure. All right? So that's another disadvantage. Okay? Then these are the credit journals. We spoke about them earlier on, so I won't go through them. You guys can read through them. All right? And then these are examples of transactions that would be recorded in the CJ. All right? Credit purchases of trading inventory, non-current assets. All right? And then consumables. Okay, you guys can read about this. But the best way to master it is via doing exercises. Then again, we spoke about the creditors adjustment journal or allowance journal, and we know that that's for rebates, okay, for things that, or rebates or returns for things that were initially bought on credit. All right, the debtors journal and the debtors allowance journal, we know it's exactly the same, but it's now just the other side. We're the supplier, and we have a customer who's bought from us on credit, or a customer who's returning something or requesting a rebate from us in the debtors allowance journal. Okay, the structures of these things you guys can go and see in your books. Okay, so I'll leave that to you. Okay, not too much of a slight difference from what we have seen thus far. Okay, the general journal, however, is quite different. So I think maybe let's just have a look at the general journal on page 140 in my text, I think. Page 140, yes, on my, so there you can see it. But this will all make sense. You've got a debit and a credit side in the general journal, okay? As opposed to multiple columns and then the totals, different accounts on those columns. Okay, then here we're just speaking to the general journal, its function. As we highlighted before, it's where we record all the transactions, cash or credit, all right, that have not been recorded in any of the other journals. Okay, then completely different structure to the other journals. Okay, that we just said, and that's fine. And then we have, this is the last thing, yes, the general ledger reconciliation statement. Okay, and please just turn with me to page 174 so we can see this thing, understand it. Yes. So for you guys, it's the document just before question 5.6. I know that will probably be a different page in you guys' textbook. Okay, so the function of the general ledger reconciliation statement. This is when we've done our trial balance, but guess what? It doesn't balance. That automatically tells us that somewhere in our books, we either debited something or credited something wrongly. Okay? We either overstated something or understated something. Or we actually might have left out something in our books. That's why our credit is not matching our debit. So we use the general ledger reconciliation statement to identify where we may have made the mistake and then rectify. Okay? So if you look at that, you'll see that you have the incorrect trial balance, and like I said, look at the debit and credit on the incorrect trial balance. They don't match. Then you have recommended adjustments. So you've identified the errors where you may have gone wrong. Then you need to make those adjustments. Okay? This account we need to debit it by so much. This account we need to credit it by so much. All right? etc. etc. This account maybe we need to remove something, and by removing something we reversing, right? So we do the opposite of what may have initially been done. Okay, just want to finish this. I see your hand. I'll do it now. Then once you have put in those recommendations, recommended adjustments, you then need to rebalance each account. Okay, And that's what's happening in the corrected trial balance state. We're now we're now putting in the correct balance after having done the recommended adjustments. Okay, and then wow, can you imagine your debit and credit balance? Okay, they are exactly the same. What did you want to say?
Sir, it's not an out.
It's not in your textbook.
We just trust the heading.
Okay. It's before question 5.6. You don't have a question 5.6? Do they have anything that speaks to the general ledger reconciliation? Do you have a 5.3 that says general ledger reconciliation? It's actually just a title. Like this. Wow. Yeah. Okay. Might just be irrelevant. If it's not in your textbook. I don't know. Might just be. Okay. Just double check that you, let me see here. Because this question 5.6 is the actual. So do you have a question 5.6?
Yes.
And under the required, what does it ask?
Calculated outstanding
Outstanding what?
Calculate the amount outstanding by.
You list his account name. That's all.
Okay, let me have. Okay, so this is something totally. All right, cool. Okay. I won't comment on it now because I know people will hold me to whatever I say. But thank you for letting me know about that. Well, at least now you know. So that might just be information that you have for the sake of or for your own personal benefit. Okay, right. But I don't imagine that they would ask you something that's not. So yeah, but I will have a look and find out how the lecture goes. Right, guys. That is it for today. Are there any questions or thoughts?